Given the turbulent nature of today's investment markets and that the stock and bond markets are struggling, how should portfolios be positioned today to reduce volatility and take advantage of opportunities to enhance long-term returns? Today, I'm interviewing Andrew Altfest, the president of Altfest Personal Wealth Management, to find out Altfest's outlook on the markets and the economy, learn why Altfest thinks managing risk in one's portfolio is now more important than ever, and to identify what types of investments we find attractive in today's environment and why. This is the second of two videos with Andrew Altfest on how Altfest is positioning client portfolios during the current turbulence in the stock and bond markets. So Andrew, you said a little while ago that alternatives make sense, especially in today's environment. Can you explain more on a macro level why alternatives are good, why the traditional stock bond really isn't good for today's environment?
Yeah, so you have to look at the risks today and say, well, how can I manage the risks as well as the opportunities? So if the risks are that interest rates are moving up and that could put pressure on stocks and bonds, so what else in a scenario in which there's higher inflation that's pushing interest rates up, what else can perform well? At the same time, what are the opportunities today? And so what's priced well, what's priced reasonably? So we have created an alternative category. We don't like all alternatives. We like alternatives that are priced reasonably and that can do well in a higher inflationary environment. So those investments are infrastructure investments. Those investments are real estate related investments. Those investments are investments that have hedge characteristics. So we actually have a strategy that allows for downside protection using options while giving up some upside protection as well. And then finally, we have a strategy that we manage internally called the Alternative Alpha portfolio that allows us to be very flexible, allows us to bet against stocks that we feel are going down, and just be tactical and nimble to manage risks as they present themselves today.
So Andrew, as you were saying, you mentioned an in-house investment that we've created called Alternative Alpha. It's an alternative investment. Can you tell us a little bit more about it and why we think it's so attractive or potentially very attractive in today's environment?
Yeah, so the Alternative Alpha strategy is a strategy that we manage for our clients. We've managed it since early 2020 when volatility increased, and it allows us to express our views very quickly and be very nimble. We do that across a number of ETFs. And while our benchmark is a moderate stock and bond portfolio, we're able to be creative in the ways that we are expressing views. So for example, going into this year, we were concerned that interest rates were going to increase, and the speculation that was really rampant in the stock market at the end of last year with technology stocks, but cryptocurrencies and meme stocks going up significantly in value. We were concerned that speculation was going to leave the markets as interest rates moved up. And so what do you do if you have a traditional stock and bond strategy that faces pressure from interest rates moving up? Both, if you want to hedge stocks, usually you're buying bonds. As the stock market goes down, people tend to move to bonds. There's a flight to quality, flight to safety,
right.
And bond prices will go up in value. Their interest rates will go down, but if the reason the stock market is selling off is because interest rates are moving up, interest rates are the arch enemy of the bond market. Right. So interest rates move up, bonds go down. So what are you doing? Well, for us, while it was a good idea to reduce the risk of the stock market by owning long-term bonds before COVID, now we decided to bet against certain parts of the global stock market by shorting those parts of the market. And so when the market started to sell off, those positions started to increase in value. And so these are the things that we can do opportunistically within the Alternative Alpha portfolio. The Alternative Alpha portfolio has performed very well this year. It's up over 10% compared to a traditional stock and bond strategy. And since its inception, its correlation is fairly weak against a traditional stock and bond strategy, which is also good. It allows us to reduce risk, and why we see it as an alternative, because it can behave, and we expect it to continue to behave differently than typical investments in a portfolio.
And so, Andrew, also, Altfest created another in-house investment called Arden Woods, and you were the leader of this creation. So can you tell us a little bit about Arden Woods, what it is, and what prompted you to want to create an investment product like this?
Yeah, so Arden Woods is a strategy that's near and dear to my heart. It started with my personal money years ago, and we're value investors.
Right.
And so the ability to be able to buy something for less than it's worth and to make your money a purchase is very attractive to us. I grew up hearing that you should be buying quality clothes at discounted prices instead of buying Ralph Lauren at the mansion on 72nd Street. You can go to Woodbury Commons and buy it 80% less. Perhaps it's 2 sizes too big and it's wrinkled in a box, and it needs to be tailored and ironed. That's great value.
Right.
And so when you can buy, the real estate market also has that dynamic, or can have that dynamic, where you can buy things much more cheaply than they're worth. And so when tax delinquent investing first got on my radar, it was something that I was very interested in. And I was not interested in the type of investing in which you're buying liens, because the returns there are too low to be interesting, and you have to use debt to juice them up. Rather, getting the property at a discounted price was very intriguing to me, and I thought compelling, and so I did it with my own money for a little while, and then I said, this could be something really good to offer our clients. And we started to work on scaling it. We now have 3 full-time real estate analysts who are working on this strategy under our direction. And in the Arden Woods Real Estate Fund, we own 36 properties now, and those properties, we believe, were purchased at very good prices. And the properties that we have sold in this strategy, the returns have been very favorable. A typical investment for us, I think we're gonna get into a little bit more of a profile of what we've been doing, but we think that we expect it to be a very strong performer.
Right, and so kind of building on what you were saying, of course, every property is different, but can you kind of paint a picture for our physician audience about, the life cycle of a property in this investment, from like, where do you find it? You said tax lien, so do you go to an auction to, what shape is it in, to do we do rehab, and how long does it take approximately to go from buying to selling, so that our physicians can get a kind of flavor of what you're talking about?
Well, we're in, right now we've purchased properties in 5 different states. We buy at auction. We like the characteristics of being in person, although some of the auctions are online. And so you have to come up with money. Often you have to come up with money immediately after the auction, and you have to write a check that can be very large depending on the value of the property. And so the properties are almost always in need of significant work. You're not understanding immediately exactly the work entailed. You can't enter the property before the auction, and so you have to budget the right amount for a rehab. And so this is a strategy in which the you're feeling like you're doing good as well, because the properties are almost always vacant. They are blighted properties in need of significant repair. They're tax delinquent, and they can be unsafe. They can be the source of crime in a neighborhood. And so you feel like the returns are there. You're doing good work in the community. You're taking these blighted properties. You're finding what are often moderate income home buyers for these properties, and we all know that there's a shortage of affordable housing today. So all the characteristics line up for a healthy investment, and one in which you feel like you're doing good in the community as well.
That's great. And of course, in terms of, this is a complex investment. And so, if any of our physicians had interest, they'd have to speak with us. We'd tell them all about it. There's a very big, disclosure documents and so on. But just on a high level, what are some of the key things to be aware of, before going into this type of investments? I know that the money that you contribute will be illiquid for a period of time. Anything that you have to say about that?
Yeah, this is an illiquid investment for accredited investors, and what that means is that you should not be thinking of this money that you'll need in the very short term. Not to say that these are, the projected holding period is not super long, because we're not looking to buy these properties and rent them out for income. We're looking to buy these properties at very steeply discounted prices, get title to these properties, make whatever improvements need to be made as quickly as possible, and then turn around and sell these properties to likely first-time home buyers, and realize our return, because the sooner we do that, the higher the return is. But this is not money that you'll be tapping into to write checks, obviously. So I think everyone understands that. There are K1s that come with this investment. Our goal is to not go on extension, but everyone has to be prepared to go on extension.
Right.
And so these are some of the details that we talk more about to make sure that this is a suitable investment for a client of ours. But the characteristics are quite compelling. The returns have been quite compelling, and this is something that we feel very good about.
So Andrew, to our physician audience watching right now, given the current market and economic situation that you outlined earlier, does that bode well for any positives or negatives for an investment like Arden Woods?
Yeah. So real estate has been a good inflation hedge historically. After all, if you look at what inflation is, the real estate and housing related costs are a significant component of the inflation equation. So this is what is affecting people's bottom line, and what they have to pay more for is housing today. So real estate can behave independently. Real estate has been a good inflation hedge. Now, we're trying to buy mostly single-family homes at deeply discounted prices. We're trying to not allow. We don't want the housing market to make our returns. We're not looking for the housing market to make our returns.
Right.
The part of the housing market that we are emphasizing overall tends to be lower priced homes that we will renovate and then sell them to home buyers. And so if I'm putting a $200,000 fully renovated home on the market that is turnkey, that someone could finance most, if not all, of the purchase price, then that is a differentiated product in today's housing market, in which the average house might be $400,000. So we're emphasizing homes that are starter homes where it's harder to put supply on the market, and we like that segment of the market because we feel that segment of the market will continue to do well, and it's a seller's market still now. We'll see how things change going forward. We like what we're the part of the market that we're in, and we like the prices that we're paying, and we feel like those are the that will, if you're getting something at a good price, you can sleep well at night. You don't have to worry about as much about what's going on in the housing market.
Well, thank you so much, Andrew, for being on today's segment of Wealth Matters for Physicians. I think you've given a lot of great food for thought for our physician audience, and we look forward to hopefully you coming back on the show another time.
My pleasure, Mike. It's been fun.
Excellent. If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or retirement ready analysis, or discuss any of your other personal financial planning areas with an Altfest professional at absolutely no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video below. If you like today's video and would like to get notifications when we upload new videos, please remember to click the subscribe button and to smash the bell icon below. If you think that a fellow physician would find this video interesting or helpful, please share it with him or her to help them get their finances optimized. Lastly, as always, this is channels for you, and we want to make it as helpful and as enjoyable as possible. If you have any topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So just please share your comments in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and remember to keep on optimizing your finances, or let us help you if you'd like.